So let's walk through this first with an example of an e-commerce business. So here we're saying that we are a company that sells sweatshirts. So with unit economics, you always have to start with the breakdown of one individual order. Okay, for this business, we're going to say one individual order on average is $129 of revenue. So that's called the average order value. So we're saying $129, and the COGS, which is the cost of goods sold, those are the direct costs associated with the product, are a couple things, and we're keeping it simple for this example. We're saying the product costs $43 to manufacture, and then the shipping associated with the product is $18. So there are $61 of costs, which leaves us with 129 minus 61 is $68 of gross margin, or sometimes we call it gross profit. So that's a 53% gross profit margin. But we had to spend $71 in marketing, so let's say in paid advertising, to actually acquire this customer. So if you look at your marketing spend and you look at a period of time, let's say you spent thousands of dollars and you got hundreds of customers, the average marketing cost to get one new customer to buy for the very first time is called your customer acquisition cost, or we call it the CAC. So this is your blended CAC. So we made $68 on the customer, but we actually had to spend $71 to get that customer to buy. So after marketing, our post-marketing profit is actually negative $3. We lost money. So at first glance, you would say, okay, so this is not a good business because it actually loses money after you do the marketing. However, most customers don't buy just one time. Most customers buy multiple times, and depends on the type of product and the type of business. But with e-commerce businesses, generally you'll see customers buy at least maybe 1.5 or 2 times. So let's say we look back at all of our historical data. Let's say we look back at the data from the prior year, the prior couple years, and we looked at the total orders coming from those customers, and we saw that the average customer didn't just make one order, they actually made 1.6 orders on average. So a bunch made 2, a bunch made 3, a bunch made 1, and the average was 1.6. So in this scenario, basically, you had your $129 of revenue per order times 1.6, so that's $206 of revenue per customer. So that is really your lifetime revenue. Next, what about the cost of goods sold? Well, all you need to do is multiply the lifetime orders times your cost per order. So in this scenario, you see that we just multiplied product and shipping by 1.6. Our total costs are $97.60, and the gross margin is still 53%, of course. And we have $109 of lifetime gross profit. So your lifetime gross profit is a concept called your customer lifetime value, which is probably the most important metric for any startup and really any business, because this is the profit that you expect to make on a customer. Even if they buy for the first time today, you can predictably forecast, if you have good historical data, that you will end up making about $109 on this customer. And so why is that important? Well, the second time they buy, we likely didn't have to do any marketing. Maybe they're on our email list, and so they're just receiving our marketing emails. So the customer acquisition cost is still only $71. And so now that they've made their additional 0.6 orders, we actually have made $38 on our customer over their lifetime. So if you look at it from this perspective, the unit economics are actually profitable for our customer. But if you were to just look at it on a one order basis, you would incorrectly think that the business has bad unit economics, or is unprofitable and should do something else. But if you looked at it on a lifetime basis, then you would understand that things are profitable.